I'm Charlotte McLeod with investingnews.com, and here today with me is Eric Nuttall, partner and senior portfolio manager at 9 Point Partners. Thank you so much for being here. Great to have you back.
You bet. Good to be with you as always.
Yes, great to be catching up. And it's been a little while since we had you on. So before we get into what's coming up in 2026, I was hoping we could take a brief look back at 2025 for the oil market. How would you characterize last year? Were there any big surprises, or did it play out as you expected?
I would say there were a lot of surprises. Last year was incredibly volatile. The market had to deal with a lot of different dynamics. Obviously, there was President Trump and his Twitter feed and what that would offer the markets. We had to deal with economic uncertainties around tariffs, which I think with the passage of time turned out to be much ado about nothing. The biggest shift, though, was OPEC policy, where in February, March, they decided to begin returning barrels to the market. I would say that caught the market off guard, and there was uncertainty in terms of, well, how well would the market be able to absorb those incremental barrels. So the price of oil ended up down, I think, roughly 18-19% on the year. What was interesting was that energy stocks performed far better than I think most people thought. My fund was up roughly 18%. So we were quite happy with 2025, given how challenging of a year it was to navigate. And it makes us even more optimistic on what 2026 may hold.
Well, and let's get into what you see coming in 2026. And I thought we could start on the supply side. One point that I have seen you highlight on X is that we're going to see a peak this year in non-OPEC production. And of course, we've talked in the past about the twilight of U.S. shale. So I wondered if you could unpack what you're seeing there.
You bet. So a huge dynamic, something we've talked about in the past, was the maturity of U.S. shale. We can see it in terms of the lack of ability to meaningfully grow for most of the basins. There's three major basins in the United States. There's the Permian, the Bakken, and the Eagle Ford. We think the Bakken and the Eagle Ford are now plateaued at decline, and now the Permian finally is. Just last week, the EIA actually forecasted the peak in U.S. shale production. So that was kind of validating what we're seeing. So why is that so important? Over the past 15 years, U.S. shale has been 117% of total non-OPEC supply growth. And so let's make that make sense. Non-OPEC production is about 2/3 of global oil supply. And the biggest dynamic, or in fact, all of the growth, has been U.S. shale. There are a couple countries growing and will be able to grow for the next several years. Canada being one of them. We've got the resource. We've got pipeline egress increasingly. Brazil is growing. Argentina a little, but in net, most oil producing countries are mature. And so we reference work by Energy Aspects, it's a globally recognized and respected firm, that says the production from non-OPEC is peaking this year, 2026. So that's very, very, very important. And I think people are unaware of, one, it's happening, and two, just how significant it is, because we had the biggest bear last year. The IEA say, well, demand's going to grow under their base scenario to 2050. So, demand's roughly 106.5 million barrels per day, whether it's going to be growing to 120 or 134, depending on which source you use. That's a lot of demand growth. And so where is the demand going to come from? Well, it's not going to be non-OPEC. So now we have to look at OPEC, Saudi, UAE, etc. Our estimates is that in aggregate, they only have about 1.4 million barrels per day of spare capacity. That's a very, very, very small amount. And that represents just over 1 year of demand growth. And so, let's assume we're going to be talking next year. Well, we'll be talking about the rollover in non-OPEC supply. We'll talk about how OPEC spare capacity has likely been windowed down just a little bit more. And yet demand will be hitting record after record after record. And so there's a digestion period that the market is in now. We are having to absorb the barrels that were put on by OPEC last year. So it's a process, but it really feels like the market is looking through the builds of today to what are going to be the draws of tomorrow. So it's really a second half story for oil. We think that oil is bottoming. Calling the exact price is a mug's game. That feels like it was 55. This is the most anticipated supply glut in the history of humanity. And so, the market is a discounting mechanism. You would think that, the known knowns are being fully discounted. And yet the market's looking through it and saying, well, geez, what happens when U.S. shale has peaked? What happens when OPEC is normalizing their spare capacity and yet demand is growing? So that's the outlook on oil. Natural gas, we're very bullish on as well, especially given the sell-off we've had, which has been largely weather-induced. There was a lot of optimism around December of 2025, January 2026, and sure enough, Mother Nature, pulled a surprise. We're bullish on oil not because of weather. We always kind of assume normalized weather. Why we're bullish on natural gas is the build out in LNG, that's liquefied natural gas, both in Canada and the United States. It's a ratable, meaningful change year after year after year. So this year, 2026, the US is going to be growing demand by about 3 billion cubic feet per day. Canada, as the second part of phase one of LNG Canada, continues to ramp. That's going to add another BCF a day. So that's 4 BCF a day. There's other elements to the bullish thesis, electrification and AI and data centers and all that. But the bedrock of our core bullish thesis is companies have spent multi-billion dollars building out these facilities. There is a global call on natural gas. Even if there's a bit of a surplus in international markets, we still think the marginal cost of supply in the United States is about $4 per MCF. That's the required price to motivate producers to drill in the Haynesville, which is a large but higher cost basin to satisfy demand growth. And at $4, we can get very, very excited about natural gas stocks. So I would characterize our outlook for 2026. Oil, cautious-ish a little. We don't see meaningful upside in the next couple of months, but it's really about the second half of next year and 2027 and the year beyond. We think we are on the cusp of a multi-year bull market for oil. And for natural gas, we remain bullish.
Okay, that's a lot for us to unpack there. So oil coming up in the second half of the year, natural gas. So is that a more immediate story for you in that case?
It is, especially we've had a pretty significant sell-off in natural gas stocks. It's our preferences in the United States. These companies are larger market cap, more ability to be relevant. More importantly, they have production closest to where demand is growing, so they get preferential pricing. It makes sense. You don't have to ship your gas nearly as far. And so where's demand growing? It's LNG facilities in the Gulf Coast, and it's data centers around the northeast of the United States. And so that's where the Marcellus is, and that's where the Haynesville is. But with U.S. companies or U.S. stocks, they are subjected to be caught up in certain investment themes. And so AI data centers, that was very, very buzzy, in 2025. It added to a volatility in those stocks. Natural gas as a commodity is probably the most volatile commodity on the planet. And then you add on the funds of flows from different, thematics. So we saw natural gas stocks sell off pretty dramatically. We get excited because I think $4 is a fundamental floor with upside depending on weather, which is actually finally improving now. But at $4, we can buy into companies with 20 plus years of drilling inventory. And because of the sell-off, they're trading at 14% free cash flow yield. So what does that mean? Well, at $4, they generate enough cash flow to keep production flat and could buy back 14% of their shares outstanding year, which they're actually doing. And so, we're bullish on natural gas in the shorter term. Medium term, we're much more excited about oil. Natural gas, there is a ceiling price. Industry has gotten so good at drilling it. We think $5, depending on, is there an interruption or a pipeline goes down or whatnot, but $5, I think, is a reasonable ceiling. Oil, however, when we think about, okay, what does the world look like post US shale? US shale taught us all that there's this abundance of low cost reserves and, they can be profitable down to the insanity at the peak euphoria was like $20. These companies would make so much money. We know that was nonsense. We are in a post US shale world. And so that means that to satisfy demand growth, and we must satisfy it as an industry, where are the barrels going to come from? It's going to be offshore. That is not a $50 world. That is not a $60 world. I don't even think that's likely a $70 world. We have to have the oil price go high enough, stay there long enough to allow companies to start pivoting away from shareholder returns and actually start drilling again, exploring again, developing again at size. So I think we're saying 70s. I do think that's being quite conservative. We think the upside is meaningfully above that. On an inflation-adjusted basis, oil is probably the cheapest commodity on the planet. There have been so many false narratives. The biggest proponent of them has been Donald Trump in recent quarters. And so I think that's really lulled the market into this false sense of complacency. Meanwhile, we're walking into a supply crisis that's coming, much sooner than I think people may be aware of.
And for prices, is that a price level that you see us getting to for oil in that second half of the year when we start to see maybe a turnaround?
It's really hard to say. I can just talk to fundamentally where we think it would be. Oil is driven really more from the financial markets and the physical markets. There's as much as a 50-to-1 ratio. For every barrel produced, 50 of them are traded on a daily basis. So I've, doing short-term calls, I think again is a bit of a mug's game, but what oil price, when we talk to oil companies, do they need to start being able to grow again? We think it is at least $70. And to motivate companies to go start exploring and spending $200 million on an exploration well, then this will feed into maybe a conversation on Venezuela. Like the oil price today is too low to warrant sufficient investment. And there has to be that profit motive. There has to be the willingness of shareholders to allow these companies once again to take capital out of shareholder returns, buybacks and dividends, and redeploy it into the ground. The only thing that will allow that is a meaningful price rally.
Well, and I think you're right. We should pivot over and talk about Venezuela. I know you've mentioned elsewhere online that this is pretty much noise for the oil market. So can you explain what you mean, what you're seeing there?
Yeah, so the market ran with the narrative that, okay, Donald Trump, he clearly wants lower oil prices. He's going to, one, take over the country and, to give safety assurances and allow companies to go in. And there's all this oil and largest oil reserves in the world. And it feeds into, well, geopolitically, what does that mean for Canada? The United States doesn't need us anymore. And we're kind of screwed because we've been too dumb as a country to build out adequate pipelines, egress, etc. Okay, what's the reality? One, the oil price is too low to allow companies to invest in what is still a very uncertain regime. Secondly, there are profound infrastructure challenges. Above ground, below ground, you've had a massive exodus of skilled talent. You have a pipeline network that hasn't been invested in for 50 years. There was a leaked PDVSA report that estimated the spending was something like 63 or $66 billion. That's like in 20-year ago terms. The view now is it's about $100 billion just for the pipeline networks. You've got to invest in tanks. You've got to redrill wells. This is not an overnight thing. And earlier we talked about, peak production for non-OPEC is coming to a theater near you. And so by the time this country can actually resurrect production, assuming the companies will actually go in, and despite the initial meeting between executives and Donald Trump, you had Exxon saying the country is uninvestable. I think that was what most people were thinking. He was the only one brave enough to actually say it in that meeting. You talk to companies, I talk to people that have fairly good contacts with higher up executives, and they would measure the appetite to go into that country as extraordinarily limited right now. And so you hear on the fringe the odd company, wildcatters, etc., but Exxon's not running back into country. We don't even think Chevron is at scale going to be able to meaningfully grow production. Low hanging fruit, maybe a couple 100,000 barrels per day over the next year and a half or so. But the real heavy lifting, adding 1 million barrels per day we're talking the 2030s, I think, before that could actually transpire. And by that point, the world would be desperate for every single barrel that Venezuela can produce.
And so my understanding is you use this Venezuela situation as a buying opportunity for Canadian oil stocks. So can you we've talked a little bit about where you see opportunity in natural gas. Can you talk about the oil side?
Yeah, it's the best opportunity for an investor is when you identify a catalyst or an event where people are acting out of fear or panic, misinformation, ignorance, coin it however you may, and stocks sell off. And so we had some names fall, I think it was 12, 14% over a 2-day time period. And we used that to gobble up a number of names where either we didn't own them or we had a smaller weight, like a 4%. There was one name, so it's a mid-cap Canadian oil sand company. It was a 4% weight heading into that event. We love the company. It was just in terms of short-term cautiousness, we couldn't get as enthusiastic on the near-term price upside. Well, the stock had fallen 18% from its peak. And so we were dealing with a Canadian bank and they had somebody selling 4 or 5 million shares strictly because of the Venezuelan headline. So we happily bid them at a discount. We bought 4 or 5 million shares just off of that one. We bought more from that. Well, why did we do that? Even at $60 oil, this company can generate meaningful free cash flow. They're ongoing buying back 10% of their stock. They're organically growing production from one project now. They have another one, which they should be sanctioning later on. So they're meaningfully growing their production. And at a time when U.S. shale companies are running out of inventory, this company, once they ramp all of their projects to full nameplate capacity, they'll have 40 years of stay flat inventory. So, well, why is that important? As these companies buy back their stock, you're able to compound the impact of that. We referenced before, I think $70 is a reasonable floor in the medium term, let's just say. Well, at $70 oil, they could buy back 45% of their shares outstanding over a 5-year time period. So within 5 years, you can buy back, let's say, half of the company. And yet they'll have 35 of those 40 years of stay flat inventory for free. And so we've made a lot of money for our clients practicing that philosophy, looking at the compounding impact of share buybacks. And when the market gives you an 18% sell off, those are kind of gifts. So that's a type of company that we added to a few weeks ago, and it's worked out quite well.
Well, thank you for going into that. And as we're talking about the companies, are we in an environment right now where we could see M&A activity pick up in 2026? How are you looking at that?
So last year was very active from an M&A perspective. We unfortunately lost 3 of our favorite names due to that. It's what happens when sentiment remains poor, which it remains very poor now. Like, this is a sector that's working, and yet it bleeds money every single day from outflows. It has for 3 years now. So as we look at it now, if I was a US shale company, I'm now at a point where publicly I can acknowledge that I have an inventory challenge. The question is degree. How do I look relative to others? Almost every company, there's the odd exception, but most of them have a profound inventory challenge. You have to replace that. The only jurisdiction on the planet that you can do that is Canada, where you can apply your technical skill set, its proximity. There's now, good rule of law. There's a government that's a little friendlier towards the sector. So the winds of change have blown. This is where you're going to come. So that's the dynamic. Companies that are inventory rich, however, are trading well below what we deem to be fair value, they are potentially vulnerable if valuations don't expand, to be a feedstock for companies that have an inventory challenge that they have to fix. So I can see the theme of 2025 continuing into this year.
And as we're talking about Canada as well, I think the last time we spoke, it was just after Mark Carney was elected as Prime Minister. I'm wondering if you have any thoughts you would share on how he's impacting the oil and gas sector so far in Canada.
I would recognize that there's been an improvement in tone, in the change of messaging from the government, a recognition, at least publicly, orally, that this is a sector that matters to the Canadian economy. But there's been a whole lot of talk and very little action. There is an MOU, it's called the Grand Bargain. I call it the Grand Ransom, between the federal government and the Alberta government in terms of, okay, what has to happen for us to build a pipeline? And, will industry go ahead and have to spend $24 billion on the Pathways Initiative to sequester the barrel? We're told by the federal government that to be able to compete in the future as an oil producer, we must lower the carbon intensity of our barrels. That is completely idiotic nonsense. It drives me insane. If I had the opportunity to ask that exact question to an unnamed CEO of a very large oil sand producer, and I said, XYZ, how many of your clients care about the carbon intensity of your barrel? It took him 3 nanoseconds. I hadn't even finished the question for him to say 0. There is a demand for every barrel that can be produced. China and India want to buy the safest, most reliable, and cheapest barrel on the planet. There's very little, but in fact, there's zero appetite for this necessity to invest in a multi-billion dollar project when we're the only country in the planet doing this to ourselves. This is such a critically important industry for the Canadian economy, especially given the macro economic backdrop facing us today. And so there's been an improvement in tone. It should not be this difficult to recognize that a tubular piece of steel can lift millions of Canadians out of poverty, but it's a very contentious, debatable, apparently a no-brainer still for different levels of the government. So I'm more optimistic. We don't have to talk about windfall profit taxes, and a lot of the environmental zealots or wingnuts in cabinet are no more, but there's still a lot of work to be done.
Good to get your take there. And as we're wrapping up, I think this has been a great review of oil and gas heading into 2026. Any final thoughts you would leave with investors?
Yeah, I've rarely, in fact, never in my 24-year career have I seen such a massive contrast between the near term and the medium term. For the oil market, this is the most anticipated supply glut in history. Everybody knows, air quotes, that inventories are going to build, the price is going to sell off. Is it 50? Is it 40? I mean, is it 35? Whatever. I disagree with that. When there is an event that is widely anticipated by every participant in the energy sector, it's likely now being discounted. We look at different metrics, and there's no levels of panic or fear. In fact, a lot of the builds that we should be seeing, we are not seeing yet to the degree that we should be. So it feels like the worst is largely behind us. I would encourage people really try to take a medium-term perspective, like ignore the day-to-day headlines. Where are we going as an oil market? U.S. shale production, when the U.S. government itself is now saying, okay, we're in decline. Well, you just lost the largest source of supply. In fact, the only meaningful largest source of supply over the past 15 years. That is no more. In a market where you have demand for the next several decades at a price on an inflation adjusted basis is near all-time lows if you ignore the COVID lows. And at a time when OPEC, major countries within OPEC, are not really investing in new capacity because they have other regional priorities or domestic priorities. So there is a imbalance coming between supply and demand growth that should lead to meaningfully higher oil prices. If you use the current price, I'm going to round, let's say $60 oil, companies are generating massive amounts of free cash flow. But my God, you can get really excited if you just tack on another $10 to $20 in that oil price. And that's what we need to allow companies to go and explore again and, go offshore again, go into, frontier regions, etc. And for natural gas, it's a very easy thesis. We have just massively sold off because weather disappointed short term, when the real bull thesis revolves around the increase in LNG demand. That's going to grow this year. It's going to grow next year. The United States is going to grow by about 50% over the next 5 years. Canada, we're going to add 6 BCF a day by the early 2030s. And that gas has to come from increasingly high cost basins, which we think as a minimum is $4. Well, at $4, given the sell off in natural gas stocks, valuations are very, very compelling. We see 30 to 50% upside, we think, in some of the largest natural gas producers. So it remains an opportunity target rich environment. Whether it's gas, whether it's oil, you can pick, but we remain bullish in the outlook for 2026.
Well, as always, a great summation of what's happening in oil and natural gas. So thank you so much for coming on today to go over everything.
My pleasure.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Eric Nuttall with 9 Point Partners.